What are the tax implications when flipping a property? Is it active income taxed at the ordinary income tax bracket? And is there a self-employment tax on it? Is it beneficial to do a cost segregation study for bonus depreciation for a flip? What is the best entity structure for flips? That's like 4 questions in one.
So we got 14 questions today.
Yeah.
This, I really liked it because it throws a lot of misunderstanding in. And so we just wanted to straighten it out here. First of all, when you're flipping, generally speaking, it's going to be active or what we call non-passive income, most of the time subject to employment tax. However, when we were before the show, Toby was pointing out, well, if you don't materially participate in the flipping business, maybe Toby and I go into a flipping project and true to nature, Elliot doesn't do anything. Toby does all the work. I mean, I'm just kind of passive. Well, then in that case, for me, it wouldn't be subject to employment tax probably there because it is passive, but he's active, it would be.
It depends on your material participation in that endeavor. If you're not regularly working in that flipping, then you're probably going to be passive. If you're passive, it's still ordinary income. So you're still at that federal 0 to 37%, but you don't have employment taxes on it. The FICA, the self-employment tax, the Social Security, the Medicare, which is 12.4 for old age, disability, and survivors insurance, and 2.9% for the Medicare. It goes up, goes down, then it goes back up. There's all these little quirks with it, but you don't have to worry about that if you're passive. If you're active, and here's the deal. Flipping a property does not matter how long you held it. There's cases where people held it 10 years and still were treated as though they were holding it as inventory. You are a car dealership. You just have houses on your lot. When you buy a property with the intent to sell it, it is flipping. Ordinary income, subject to self-employment tax if you are doing everything. So the way you minimize that punch in the neck is you're going to use an S corp or a C corp to make sure that there's something there between you and that in that enterprise from a tax standpoint. We want to make sure that when that income comes in, let's say it's through an S corp, at a minimum, we're minimizing the self-employment tax or the Social Security taxes. Technically, it's Social Security. So let's say I make $100,000 and I just earned it myself. Let's say it's Elliot's the sole proprietor and I'm the S corp. Elliot makes 100 grand. How much employment tax are you going to pay on that 100?
I'm only going to pay myself a reasonable wage, W-2
You're the
wage.
sole proprietor.
Oh, excuse me. I'm going to pay 100% of that. Is going to be subject to an extra 15.3% that Toby was breaking down there. So I'm going to pay tax on all of it, extra tax, not just income tax, but full-blown employment tax.
But Toby, who's an S corp, I pay myself a small salary, usually about $30,000. I will pay employment taxes on that, which is about 15.3%. Half of it's deductible, so it turns the math is 14.1. So let's say, what is that? About $4,200. So Elliot paid 14,000. I paid 4,200. Elliot,
There's a lot more to it too.
Toby. Yeah.
But all the reimbursements he can do in his S corporation, it's just there's not even a consideration here. I lose out on every category, plus the audit risk. But this is a very common question. It's understandable because we're talking real estate, why we get asked it, but we often get asked on a flip, can we do a cost seg, bonus depreciation, that kind of thing. Those aren't allowed on a flip because, as Toby pointed out, it's inventory. So that's one deduction while you're looking for those deductions that we cannot take advantage of on a flip.
Right. Things you cannot do if you buy property to sell it. You cannot 1253, which is installment sales. You cannot 1031 exchange, which is tax-free, or like-kind exchanges to avoid tax. You cannot depreciate, so you don't get bonus depreciation. You cannot cost segregate because there's nothing to depreciate. It's all inventory. Boo, hiss. So it's like having a mini mart. You have Cheerios on the shelf. That's your properties. They're sitting there waiting to be sold, and they're the cost of goods sold. So you really do get hammered as a dealer if you're not expecting it. You got to talk to somebody. Talk to us if you're confused and you're wondering what your situation is going to be like, so that we can map it out for you, so that your eyes are open. There's nothing worse than somebody who thinks they're an investor and they find out 2 years later that they're a dealer and they're just getting slaughtered all over the place and they've done a bunch of installment sales, they're carrying notes. It's taxable when you sell it, even though you're not getting paid yet. So you could be underwater pretty quick. And we've seen it happen with folks, and it's not pleasant, right? So just make sure that those eyes are wide open and you're talking to somebody so you know what it looks like. And there's ways to defray that. If you're an active business, there's DB plans, there's 401ks, there's tax-free fringe benefits, there's accountable plans, 280A, administrative office for your home, way to reimburse mileage, hiring kids. There's all those things in play that you can still get a lot of money out tax-free because it's active, and it's quite different than if you're just investing. But you don't, again, when you're just investing, you have that depreciation, which really helps. You're a flipper, you don't. So we just want to make sure that your eyes are open. Somebody says, and the self-employment tax is on capital gain. There's no capital gain, it's ordinary income because it's not considered an asset. So when you buy a house and you sell it, it's inventory. No different than if you were a grocery store selling milk, right? I bought the milk. I don't depreciate the milk. It's cost of goods sold. When I sell it, it's all ordinary active income. It's not capital asset. I'm not buying it for the long-term appreciation and the cash flow. I'm buying it to sell it. And they just totally toss you. So we cannot deduct the renovation cost. You add the renovation. There's probably a question where they ask that. You add the renovation cost to the cost of goods sold. So you deduct it when you sell it. It's going to lower the amount of income. So if I buy a house for 50,000, I put 100 into it and I sell it for 350. So what did I say? I bought it for 100 and I put 50 in it. Now I'm at $150,000 basis and I sell it for 300. Then I have 300 minus 150, right? So the 50,000 that I did I probably screwed up the numbers there, but you add the basis and you add to your basis the renovation costs, and that creates the basis so that when you sell, it's just the difference. So it's the cost of goods sold is increased. If you like this clip of Tax Tuesday, then I invite you to join the actual show. It's every other week, and you can ask your questions and get them answered live by myself and my team. Just click the link.